Hi, everybody. Welcome to the Sherman Show. I'm Jeff Sherman, along with my co-host, Sam Lau.
Hey, hey.
And today is Monday, April 10th, 2023. And we are joined by none other than DoubleLine's own Ken Shinoda. Ken, welcome back to the show.
Thanks, Jeff. Thanks for having me. Thanks, Sam.
Yeah, and for those of you who don't know Ken or haven't listened to the previous show, Ken is one of our portfolio managers here at DoubleLine. He heads our non-agency RMBS, or residential mortgage team. Those are the mortgages that are not guaranteed by the U.S. government or backed by them. And also, he is in charge of our structured products committee. So Ken is someone who's an expert in all things securitized related here at DoubleLine. And I thought, given some of the concerns and things that people have had within the mortgage market, it made sense to bring him back on the show. So Ken, thanks for agreeing to join us today. And it's good to have you on my show versus me having to come on yours on Channel 11.
I'm going to drag you on there in the next couple months. So,
okay. Well, yeah. And for those of you who don't get the reference out there, Ken does host our Channel 11 news show where he interviews folks in the industry on a monthly basis, gives us monthly updates as well, and recaps the markets as well. So if you haven't checked that out as well, please tune into that as well. You can catch that on the DoubleLine website or also on our YouTube channel, youtube.com/DoubleLine Capital. So, and now that I've given everybody all the advertisements for all things DoubleLine, Ken, for those that haven't listened to the previous podcast, maybe you could just give us a brief summary about how you got into the business, your background, and part of what you do on the mortgage team.
Sure. Well, I went to school down the street from our offices at the University of Southern California, and I was studying business there with an emphasis finance. I thought I was going to go into real estate, and I ended up going into something real estate related, which was mortgage-backed securities. Just kind of by chance, got an internship at our former employer, got a full-time job out of college, and just got thrown feet first into the fire of the subprime crisis. I was analyzing asset-backed securities and subprime mortgage bonds. And then we went into the global financial crisis, which I joke was my MBA. Didn't need to go back to get an MBA because having lived through that was a really great learning experience, and expanded my horizons away from just mortgages into other pockets of the securitized markets. And started off as an analyst, went into trading, then portfolio management, and here we are today. And we've all worked together now for almost 20 years, I think.
Yeah, and we're all, except for Sam, starting to see the gray hairs. I noticed your beard last time I saw you in person a week or so ago, that we're all getting the gray hairs. Somehow Sam is still elusive. So, we won't make any accusations here on the podcast today. But for those that don't really know about the mortgage market, it tends to get a lot of headlines. So maybe you could talk about, just kind of the evolution of the mortgage market, different ways of expressing views within the mortgage market as well, and just how you've seen the evolution over time.
Yeah, when the mortgage market first began in kind of the late 70s, early 80s, it was all government guaranteed, and it stayed that way for quite some time. The non-agency or the non-government guaranteed mortgage market, while it existed, it really didn't really gain any significant size till, I would say, like the early to mid 2000s. And obviously it got a little bit out of hand towards the mid 2000s going into the global financial crisis. But kind of the main sector of the market, the agency mortgage-backed securities market, these are government guaranteed packaged pools of mortgage loans. They're issued through three main entities: Ginnie Mae, which is implicitly government guaranteed, and then Fannie Mae and Freddie Mac, which, Ginnie Mae is explicitly government guaranteed, and Fannie and Freddie are implicitly. And the bonds they issue, you take no default risk. So if a borrower goes delinquent, what happens is that loan gets bought out, you get made whole, you get paid par back. And so really what you're taking on is taking on prepayment risk of mortgages, right? If you take out a home loan in the US, you as a borrower have the right to refinance penalty-free at any point in time. And so as a bondholder, now you are exposed to that optionality that the borrower has. And for that prepayment risk, you get paid an additional spread over Treasuries, just like you get paid spread over Treasuries to own corporate bonds. For corporate bonds, they're taking credit risk. For mortgage bonds, they're taking prepayment risk, at least for those government guaranteed bonds. And so it's a way to get that extra yield with a different risk profile. And you can also make a view on the direction of rates. There's certain mortgage bonds that do better when rates are rising. There's certain mortgage bonds that do better when rates are falling. You can buy fixed rate bonds, you can buy floating rate bonds. And then you can also, as the market had developed in the mid 2000s, you can invest in mortgage bonds that don't have that government guarantee. Those are those non-agency that we call them. And you can take the credit risk, and you can take a view on that credit risk to the consumer and get that exposure in your portfolio as well. So many different ways to get both credit exposure and or interest rate exposure for various different market environments that you're in.
Okay, and then so as you think about using the toolkit of the mortgage market, a lot of people are familiar with some of the ETFs out there that really, or like the Vanguard Ginnie Mae fund that only traffic in this government guaranteed component. Why should an investor consider expanding the universe to the non-government guaranteed? And what is the size of that market relative to, let's call it the GSE sponsored or the government backed residential mortgage market?
So the government backed markets fluctuate somewhere between, call it $6, $7 to $8 trillion, depending on what homeownership rates are in the US. It's probably closer to 7 trillion right now. The non-agency market at its peak got all the way up to about 3 trillion. That was obviously a little bit too big. Bad things happened. Today, it probably sits around 500 to 700 billion, depending upon issuance. And it's kind of the same size as the CMBS market. ABS market's a little bit bigger now. But most of those securitized credit markets sit somewhere between about 500 billion and $1 trillion.
Yeah.
So
okay.
why think about adding it? Well, you can get paid a significant spread over agencies today. Sometimes it's more, sometimes it's less. Mm-hmm. And we've found that mixing agencies and non-agencies together and weighting, more towards credit when spreads are really wide, less towards credit when spreads are really tight. If you actively manage that mix between agencies and non-agencies, you're actually able to generate a better risk-adjusted return through time relative to just if you hold the index. And you can't, just sit in the static allocation. You have to, be nimble and be in the right sectors at the right time. And that's what we've been doing at DoubleLine now for many, many, many years.
Yeah. So as I run into investors today and we talk about some of the opportunities within the non-government guaranteed, or what we call the non-agency RMBS space, people feel really skeptical or they're reticent to think about it because they look at the outlook for residential housing today. And so I wanted you to kind of address kind of your outlook for the housing market, but more importantly, what this means for those RMBS structures, the non-agency RMBS structures out there where you're investing in this, because a lot of people we've run into today say with mortgage rates or interest rates, which extend over to mortgage rates being high, that it should put more downside pressure on prices. So one, do you agree with that thesis? And then secondly, how would you talk to someone about thinking about investing in this space today?
Okay, well, why don't we start with the housing market first? And the biggest driver of home prices is supply, demand, and affordability, right? And affordability has obviously gotten a lot worse because mortgage rates have gone higher and home prices have gone higher. But if you keep going back to that supply demand dynamic, it's just so supportive of housing in the long run. On the supply side, we really stopped building single family homes after the global financial crisis. There was much more multifamily being built. So there's just a lack of housing availability, especially on the lower end. So if you look at population growth relative to housing, the housing supply on the new production side, we're massively behind from a building standpoint. If you look at existing inventory just as a metric, we're about 1 million units nationwide. Think about that, 1 million units nationwide relative to an ever-growing population. Going back to the GFC, we entered that with about 3.5 million units. And then we throw on top of that the new supply of homes, throw on top of that 5 to 6 million foreclosures. There was just way too much supply going in the GFC. So today is the opposite picture. We've got very limited supply, and then the demographics are pretty positive. You've got millennials hitting peak home ownership, purchase age, household formations on the rise. So I think that is really what has been supporting the market. We are down about 5% from the peak in home prices that we got to last year. Could we go down a little bit more? Of course. I think there's probably still some downside pressure nationwide, but you've already started seeing some metros flatline, stop going down. And on the East Coast especially, there's places that are still going up in price, if you can believe it. Florida, Buffalo, there's just a wave of people moving to that southeast area in Florida, especially, that is propping up home prices, even though mortgage rates are high. So I'm not expecting a crash. It's more of a correction. Many places have already corrected. A lot of the tech-centric places in the West Coast, like San Francisco, Seattle, San Jose, they're down the most. They're probably down about 10, 15% from the top. But again, there's that drop is starting to slow, especially as mortgage rates are coming down here.
Yeah, so a couple of things that you brought up there, the strong housing prices being still supported despite kind of a big rise that we've seen since the pandemic. Tight supply and demand. These are kind of the underlying fundamentals that we heard. They're echoes of what we heard going into the GFC. Remember when people were talking about how there's just a strong, especially supply and demand imbalance here, and they're not building any more houses, or they're not building any more land, right? For houses, that type of argument. So when I talk to people, prospective clients or existing clients, they do have fears of a repeat of the GFC. Can you talk about why some of the what are some of the characteristics why we might not see that, be it bank underwriting or improved structure within securities that you might be looking at?
Yeah, that's a great question, Sam. Because the last crisis was centered around mortgages, I think that the market is now so much safer because we got thrown into the fire, and coming out of that fire, there's a lot more strict rules and regulations around mortgage underwriting, right? So first off, you used to be able to put no money down. That's totally not the case anymore. The new loans being made, most borrowers are putting down at least 20%, if not more. So the average loan to value of non-agency loans are probably around 75. So borrowers are putting 25% down. That's skin in the game, right? During the global financial crisis, what we saw were borrowers that no longer had equity in their houses would just walk away because they could rent the place next door for half price. And there's not only a lot of money being put down on new loans, existing loans that were made in the past, home prices have gone up a lot, and these people have been paying their mortgages down. So equity in housing is at an all-time high. So there's a lot of inherent equity in the housing market, which I think decreases the probability of default for borrowers. Now, outside of just the safety of the new underwriting, the regulators through Dodd Frank also put into place something called risk retention. So if you make a mortgage bond and you're an issuer of a mortgage bond, you have to keep 5% of it for up to 5 years. That's skin in the game. So what the problem with the GFC, investment bank buys loans from originator, packages up, sell the loans within, call it 30 to 60 days, never keeping any risk. And so there's underwriting quality deteriorated because of that as well. So here, through regulation, you've got skin in the game from the issuers. Most people who are doing these deals are keeping the equity, and they don't want to take losses. So I think that's a second component that makes these bonds safer. And then lastly, the rating agencies, the ones that got it so wrong during the GFC that had all these bonds get downgraded, they've got also much stricter on what they require to call a bond investment grade, especially to call a bond AAA. So for example, pre-GFC to be a AAA bond in what we call the Alt-A space, which isn't necessarily prime, but it's also not subprime. It's somewhere in the middle. It's probably an average credit score of around 700, 720. You used to need around 5 to 6% what's called credit enhancement to be a AAA, meaning that there's 6% of the bonds below you that need to get totally wiped out until you get hit. Today, that same bond probably has 20+% credit enhancement to be AAA. So at least 2 times more credit enhancement to be called AAA. So the safety of the underwriting of the loans has gotten better. The safety of the regulation has improved the risk characteristics. And then lastly, the requirements by the rating agencies have also made it much safer too. So everything just around the manufacturing and the packaging of mortgage loans is way safer than it was pre-GFC. Even when we would say underwriting quality was good in the early 2000s, we're even better than those good days, if that makes sense.
Yeah. And so when you think about kind of the evolution too, talk a little bit about the evolution of like the security types, or, you know, the kind of different ways to kind of span the non-agency universe today.
Yeah, well, let's go back to pre-crisis. We used to basically categorize by credit quality. You had prime jumbo, which would be loans that are bigger than the conforming limit to go into the agencies. Those are, we would call jumbo prime. Then we had Alt-A, we just talked about that. That's kind of like middle of the credit quality spectrum. And then lastly, there was subprime, which was something like 620 FICO plus or minus would fall into the subprime realm. And subprime really picked up steam starting in the early 2000s, and then it exploded into the kind of mid 2000s going into the GFC, largely because of the CDO, collateralized debt obligation market that fueled it. Since the GFC, things have, we've kind of packaged up new types of collateral. First off, there really is no more subprime in the non-agency market. There are subprime loans being made. They're being made by the government through the Ginnie Mae program. So the largest subprime originator in America is now the government, backstopped by our taxpayer dollars. So there really is no subprime in the non-agency market. We still have jumbo. So if I look at newly originated loans, there's either jumbo prime, there are agency eligible investor loans, right? Somebody that is renting a house out as an investment property, but it's eligible, but there's only so many loans you could send into the agency market. So they can also get securitized in the non-agency market, really high quality. And then lastly, it's something new called non-qualified mortgage or non-QM. And it doesn't mean subprime. It doesn't mean scary. It just doesn't fit a box that's been created to be a qualified mortgage. And if the loan is non-QM, it has to be, you have to have this risk retention thing under Dodd Frank. And there's a couple different things that make a loan non-QM. Certain debt to income ratio over 43, a certain coupon above the agency loan market, and then documentation. That's the main one that the market has settled in on, is basically, you know, people that don't have full doc. And these are a lot of times they're self-employed. And so the market goes and they look at bank statements and things like that. And so if you can go to the non-agency market, and this is the first part of the market you can look at: jumbo prime, investor loans, non-QM. They all have different types of credit risk. I think the credit risk is relatively low, so then it really comes down to what type of prepayment risk that you want to take. The other new thing after the GFC was credit risk transfer. Fannie and Freddie wanted to offset some of their credit risk, and so they took the bottom 5% of their credit risk on, you know, portfolios of multi-billion-dollar portfolios of agency loans, and they create a credit-linked note. And so you can take credit risk of agency quality loans, very high quality loans, and you can buy investment grade risk off of that. You can buy below investment grade risk off of that profile as well. These are floating rate bonds, and it's a great place to get that floating rate exposure. When it first came out, we thought there was some better opportunities out there, but more recently we've gotten more constructive on it and have been adding some exposure on that front. So that's called CRT, credit risk transfer. And then the third kind of prong in the stool, I would say, is legacy loans. So these are loans that were made in the past. They could be non-performing and they could be reperforming. They get sold by the Fannie and Freddie. They always have reperforming and non-performing loans on their balance sheet, and they get bought by private investors who then package them up into bonds. So I would say those are the three main sectors of the market: kind of new origination collateral, credit risk transfer, and then legacy loans. There's other esoteric parts of the market like mortgage servicing right bonds and things like that, but it's such a small part of the market. I'd say for investors to just focus on those three is where they're going to get their main exposures.
Yeah, and listening to you, I mean, you're really opening the universe outside of these kind of traditional paths of what come from the government when you're talking about these non-agency sectors. And so, one thing that's, obviously been on a lot of investors' mind in the last month or so is the fallout from some of the banking crisis that we saw. And so, thinking about implications for the residential mortgage market, are there any from what you've seen from some of these bank failures and some of the stress we still see out there with some of these other banks too that are, kind of struggling to retain depositors and the like? And how are you thinking about that and effectively what the implications are for the residential mortgage market?
Yeah, I think mainly the concern right now that the market had, but I think it's past perhaps, is that a lot of what these banks own and what caused problems weren't necessarily their non-agency book, it was their agency book, right? Banks have to own a certain amount of high quality assets, Treasuries, agency mortgage-backed securities, and a lot of them got huge deposits during the pandemic and the year after with a lot of the stimulus checks that went out, and they had to go out and buy bonds. They could make loans, but a lot of them just bought bonds. SVB just bought too many relative to many of their competitors. And so the concern was that, FDIC took over some of these banks and they'd have to sell some of those assets. They did take over the banks. They will have to sell some of the assets, but they're going to do it in an orderly fashion. Fire selling mortgage-backed securities is not going to solve the issue that plagues not just SVB, but many of the other banks. It would just create more stress in the system. They set up that new financing facility, the BTFP, where you can, if you're a bank, you have bonds that are at 80, you can finance them at 100, where normally you would finance them at less than 80 because you'd have to put up some equity haircut. Why would they be doing that on one side and then fire selling assets on the other side to depress prices? So I think that risk is pretty low. I think that one thing that has happened though is that credit creation, a lot of these smaller banks also, originate mortgages. I think that credit creation is going to slow down here. So I think that, if you used to be able to go get a more competitive rate, perhaps at a regional bank, you move some money over into a checking account or savings account, they take, 25, 50 basis points off your rate. I think that type of activity will decrease. So maybe some of that needs to get pushed into the bond market and get originated as a non-agency loan as opposed to a balance sheet loan at the banks.
Yeah. So in going over kind of the three prongs or the three-legged stool there of the non-agency mortgage-backed market, I noticed you didn't mention second liens and HELOCs anymore, so that's nice to see that those kind of things aren't really in the playbook nowadays. But could you talk about some of the scenario analysis that you run when you're trying to look at these credits to determine what types you think might be more favorable? What are some of the underlying drivers of future performance? Is it all the same? Is it just do borrowers have to continue making their mortgage payments and everything will be fine? What are the different points of analysis across those different areas of the non-agency market as it stands today?
Sure. Yeah, I mean, it's all pretty simple. I have a funny story that I was with our colleague Morris Chen, who runs commercial mortgage-backed securities group here, and we went to go see the family office of one of these big quant hedge funds out there, $100 billion quant hedge fund. And they were doing some stuff in loan origination, which is why we're there to talk to them. And we walk in there and I look at Morris and like, God, they got all these programmers coding and they've got all this statistical models are running to pick their positions. And I'm like, our business is so simple. We just want these people to pay their mortgages. Just pay your debt back. At the end of the day, that's what it comes down to. It's just, are they going to default? And if they default, what's the loss going to be? And so that's what we do is we try to predict a range of prepayment outcomes, and we try to estimate losses on these pools. And we're lucky that we have a lot of data that allows us to go back through time and look at cohorts of loan characteristics. And we can see that, obviously credit score is a big driver of defaults. But then loan to value was one of the most important drivers of defaults going through the GFC. You could have had a high credit score borrower that had a very high loan to value, meaning that they didn't put any money down if it was over 100. And a lot of those borrowers defaulted, even though they had a really high credit score. So what we try to do is we try to find what we call layered risk, where not only is the credit score low, but the loan to value is high, and maybe the debt to income is high. And if you look at that layered risk characteristics, it is so much lower than what it was pre-GFC across not just non-agency market, but also the agency market. Because the rating agencies and also the government sponsored entities, Fannie, Freddie, Ginnie Mae, figured out that, okay, if the person has a low credit score, let's make sure that they don't have a high LTV and a high DTI. Let's make sure that, well, maybe if their credit score is low, then we'll make sure their LTV is low and their DTI is low, and that'll decrease their risk. And so I think that that's another thing that has helped the marketplace, is just an improvement of those layered risks that are out there. So we see bonds, we look at the collateral, we use the collateral to help us determine prepayment expectations, determine default expectations, and then we run those cash flows through what we call the capital structure of the bond to see if those bonds will take losses. And as we talked about earlier, we feel that the underwriting of the loans are so strong, the structuring of the bonds by the rating agencies is so robust, and then throw in this risk retention thing, the skin in the game, that investment grade bonds in the RMBS space, we think have, I don't want to say never, or none, but it has very, very little remote default risk. It's all about prepayment risk on those assets. And then if you go into the below investment grade portion, we think that there's a really good risk adjusted return story, especially if you're buying at the right price when spreads are wide. So that's kind of what we do. We look at the collateral, we try to run those cash flows and figure out what those cash flows are going to be, run conservative cash flows, and then see how those bonds hold up in the different scenarios.
Okay, and so as Sam's been focusing more on the credit side of the equation. Can you walk our listeners through kind of the impact of the Fed's policies over the last decade or so? And what I'm referencing here is the low interest rate policy, the quantitative easing, definitely post-pandemic, they revisited the playbook, the Fed's balance sheet expanded immensely. And some of those purchases were heavily concentrated in the agency mortgage market. So can you walk us through what that's done to the dynamic of the mortgage market, if anything? And secondly, as we go through this balance sheet runoff or quantitative tightening, what are the implications of that on the mortgage market as well?
Great question. So what's really interesting is what's happened with quantitative easing and kind of the mix of assets in the universe. So if you look at the mortgage benchmark, for example, it's kind of like a pro rata slice of the universe, and rates move through time, they go up and down. So mortgages are made with various coupons through time. And so we call that the coupon stack, right? So you can buy a bond that's got a coupon of 2, Fannie 2s, we call them. These are bonds from Fannie Mae that have a 2 coupon, or you can buy Fannie 5s, which are bonds from Fannie Mae that have a 5 coupon. They were made at different points in time. But rates got so low and stayed there for such a long period of time that so much of the universe of mortgage borrowers has a coupon of probably 3.5%, which are packaged up into bonds with coupons of those 2.5%, Fannie 2s, Fannie 2.5s. So the index happens to, just because of time passing and where origination was, it owns a lot of 2s and 2.5s in the index. So if you buy an index fund, you probably have 2/3 of your exposures in the Fannie 2s and 2.5s. Guess who else owns Fannie 2s and 2.5s? The Fed. The Fed was doing QE during the creation of all these bonds when rates were low. And so the Fed's balance sheet, 2/3 of it is Fannie 2s and 2.5s. Guess who else owns Fannie 2s and 2.5s? SVB and all the other banks. So not only was the Fed buying them, all these regional banks were buying them because they have to buy high quality assets. So it's really hard to get the exact number, but if we were to guesstimate, we would think that there's only about something like 15 to 20% of the float of Fannie 2 and 2.5s available to buy. And the prevalence of indexation in the market broadly, not just fixed income, but equities as well, has created this demand by indexers to buy Fannie 2s and 2.5s because they're in the index. So they actually trade the tightest out of all the mortgage-backed security bonds that are out there. And, to be fair, in normal times, lower coupon bonds do trade tighter than higher coupon bonds because they typically have less prepayment risk. But I think that they are exceptionally tight today because of this dynamic of demand from indexation relative to the availability of that bond in the marketplace. So this period of time right now in the mortgage market, active management, and I know it sounds self-serving because we're active bond managers, is so important so you can extract the cheapness of the MBS market. Because you see a lot of articles out there about mortgage spreads are wide. That's true, they're wide, but the spread being quoted is what's called current coupon spread. It's that new origination bond that's being made around par. They're not quoting the spread on Fannie 2 and 2.5s, which is what an index portfolio would own. So I think right now, QE and the bank demand for those bonds during that certain time period has left us in a state where to really extract value, you got to kind of be out of index right now.
And so it was a two-parter. I know it was in depth, but what are the implications of QT on the other side? And so as the Fed is trying to reduce its balance sheet, what do you think happens to said Fannie 2s and 2.5s, or what do you think happens to the overall market? And how do you think about positioning around that?
That was a very frequently asked question, I would say, before SVB, where everyone's saying, well, what happens when the Fed needs to sell the mortgage-backed securities, even though they came out multiple times saying they're not even thinking about it and they don't need to sell mortgage-backed securities.
Not even thinking about it even too, right? That's Powell's favorite phrase, right?
Yeah, and you always get the hater that wants to argue with you that they're gonna sell the MBS. And my response was really, why would they sell them? It doesn't do anything to fight inflation, right? Like mortgage spreads are already wide, mortgage rates are already high. So pushing mortgage spreads out another marginal, let's call it 20, 50 basis points, doesn't really help them fight inflation. That's why they're just focusing on the Fed funds rate, right? And that also would lock in losses on the balance sheet. So I just thought that, my opinion pre-SVB was, I don't think they're going to do it unless they really want to tighten financial conditions because, they took rates up and they just can't get the economy to slow. Maybe they would sell MBS to push spreads wider on everything. Right? It would push spreads wider on corporates and whatnot. But now with SVB, they're adding Fannie 2s and 2.5s to their balance sheet through financing operations, right? They created that BTFP facility. So they're actually adding mortgages to their book. They don't own them directly, but they're financing them. So it would be very strange, I think, where they're financing the same asset through that BTFP facility and then all of a sudden, selling them on the other side. It just doesn't make any sense to me. So I think that, the QT, they'll probably just continue the natural roll down or unwind of the balance sheet, meaning that they'll just let prepayments and pay downs pay those mortgage bonds down. But I don't think they're going to sell, especially after the SVB incident and now having to finance the same asset on the other side. So I don't think that there's a risk of big sales from the Fed. I also don't think there's risk of fire sales from the FDIC. I think it's all going to be kind of a slow, methodical process to keep stability in the marketplace, which is also, I think, one of their goals, right?
Yeah. So there's a lot, you covered a lot today. All the stuff that you talked about across the various sectors of the market, tie that all in together for your outlook for the rest of 2023, how you're positioning for it, as a portfolio manager here at DoubleLine, and what looks attractive in your market. What are you buying?
Yeah, I mean, look, I think it's going to be a rocky 2023. While there's definitely signs of slowing growth, the job market seems to be stubbornly resilient, which is why the Fed potentially may have to hike again. I guess we'll see when May comes along. But the spreads have widened so much, and especially short-term rates. I know they got all the way up to 5 and they've dropped, but they're still pretty high relative to history. So if you focus on bonds that are at that front end of the curve, you're getting paid more yield because of that inversion relative to longer securities. And there's a lot of room for that short-term rate to fall. So you can buy AAA mortgage bonds with a spread of around, call it 200 today. The tight was probably around 80 or so back in 2021. And you're talking about a 6% yielding 2-year bond where if spreads were to widen, let's call it 200 basis points, which is a lot to go from 200 to 400, you would think that really bad things are happening and the Fed's on its way to cutting. So I think that front end of the curve gives you a lot of protection, not just because it's short duration, and so your bond doesn't move much in price relative to changes in yield, but also that there's probably the most room for that part of the curve to fall. And so you could see a scenario where while spreads are widening, rates are falling maybe even more, and you could end up with strong total returns even into a spread widening recessionary type scenario. So that's kind of where our focus has been, is shorter duration. We're finding you don't have as much need to go all the way down the capital structure anymore. Even in a portfolio that's higher risk, where you're buying double Bs and single Bs back in the day, and you get 4 yield to buy the single B. I mean, you can buy 6 yield for the AAA. So I think that across all portfolios, there's a theme at DoubleLine of going up in credit quality and creating more protection for our investors.
Well, Ken, that was excellent too. As always, you had a way of distilling this down, a very complex concept, but really making it accessible. So want to thank you for your time today. Also want to make sure that we plug all of your publications and everything out there too as well. So where can people get access to Ken Shinoda's latest thinking out there here at DoubleLine?
Yeah, check out Channel 11. We do a monthly, either a market update or sometimes we've got guests on as well. And appreciate it if you check it out.
All right. Well, and again, you guys can skip the episodes where Ken makes me come on there as well and give updates too, because they get double duty here. But before we let you go, Ken, there's one part of the show that I don't know if you remember, but we call it Sam's favorite part of the show.
Yeah, and that favorite part of the show is called Sherman Says, Ken. It's where I'm going to ask a series of alternating prompts between you and Sherman to elicit a top-of-mind response. Pave the way here. I'm going to give the first one to Sherman with FDIC deposit insurance.
I mean, isn't that what FDI stands for almost anyway? I mean, I'm just saying there's a lot of redundancy in there. Important, necessary, and the cost is likely to go up, although consumers won't really see it. It's always been a cost in there, and that cost you pay through lower rates on your savings rate. So I think what a lot of people have noticed as of late is that the banks, shockingly, were not paying them the same amount of rate they could get from lending just to the U.S. government short-term through T-bills. And I've noticed that seems to be changing a lot from a lot of the ads I've seen as of late. So, FDIC, it's important. It was created, to kind of stave off some of these runs on the banks, and that's what it's still intended for.
Yeah, I'm getting the basis point on the savings account at my bank there. So that's
yeah. Well, you're going to get rich. So that's one reason that you keep working, Sam, is that basis point of savings probably isn't going to compound out very well over time.
That's right. All right, over to you, Kenny, with bank stress.
Haven't seen the end of it, I think. I think that there'll be probably some more shoes to drop, or whatever the saying is, especially with some of the commercial real estate debt that some of these banks hold. remember there was one bank that was like on the cover of some periodical because they were like the largest construction lender in America, something like that. So I don't think we've seen the end of it, but I do think things have calmed down pretty well here so far.
All right, back to you, Sherman, with quantitative tightening.
Like the Energizer Bunny, it just keeps going and going, and like the Energizer Bunny, we don't talk about it anymore, right? So it's all going on behind the scenes, and it's going to continue until the Fed has to change something.
All right, Kenny, rating agencies.
What's there to say about rating agencies? They've gotten a little better at their jobs, but every investor should still do their own analysis and don't just buy something because they tell you it's investment grade. So that's what we do here at DoubleLine.
All right, back to you, Sharon, with AI.
A lot of hype.
All right. I guess you could.
I guess I need AI to give me a better answer to that too. So obviously I don't use it. So there you go.
After I gave it to you, I thought you might go with Allen Iverson as I was thinking about it. But
yeah. Great thing, great show, the No Crossover one on Netflix.
Check it out. Kenny, terminal rate.
Almost there, I think. We're almost there.
All right, Sharon, debt ceiling.
Almost there, as Ken just said, but it will get expanded, and especially if we have a crisis. So as I tell everybody, overlay the debt ceiling with the amount of debt spending and take it back through time, and the lines are non-discernible, right? And so it's political grandstanding. I think this one's going to be contentious, but it still gets done because these political representatives, they have constituents that have government jobs. If there's no extension, there's no payment of the wages. So at some point it has to get done. It will get done. And I still say it's all political grandstanding.
All right. Mortgage rates.
Going lower.
Jobs.
Going higher.
Wrap this up here, Kenny, with money market funds.
Sell them and buy some bond funds, please.
Yeah. Well, money markets are competitive. Ken talked about the inverted yield curve. We've seen that. And, I think it's one of the biggest things that I've ran into with investors is saying, like, why should I buy a bond fund when, the highest part of the curve is the front end of the curve, and money market funds yield more than kind of the back end of the curve. And I tell them, well, if bad things happen, you want to own duration. And by way of example, look at what's happened since March, right? Since the banking crisis, you wanted to own that. And so there's reasons to own both. Your cash probably shouldn't be sitting in a savings account today unless you need it in the next day or two. It should be sitting in a money market fund. So I think there's a place for both, as Ken said earlier. So I know that was your question, Ken, but your buy bond funds, maybe you have to come and put a cheap plug in here as well.
Well,
so.
we all own some T-bills too. It's been a good place to hide, so hard to argue with it.
That's right. It's all about asset allocation, right? So, all right. Well, Ken, thanks again for your time today. This is Ken Shinoda, portfolio manager here at DoubleLine. In addition to that, he's head of our structured products committee, has his own channel here, channel 11. If you didn't get the reference there, channel 11 is double lines, right? The one and the one make double lines there too. So Ken, always great talking to you. Thanks for sharing your wisdom with our listener base today. And again, tune in for our next episode coming soon. For those of you who didn't watch us on the YouTube, you can catch us on SoundCloud, Spotify, Stitcher, a bunch of other things like iTunes, Google Play, stuff like that. So again, Sam's always keeping an updated list, and I always forget to read it. So thanks for doing the work, Sam, that I'm not giving you credit for. So take care to all our listeners. Tune in soon. We'll have another guest coming on in the next couple of weeks. In addition to that, Ken just reminded me about the commercial real estate market. It means we need to bring on Morris Chen as well to talk about updates on there. So look forward to having him on in the near term to talk about what's developing there as well. So thanks again, Ken. And to all our listeners, have a great day out there and good luck.